Good day, everybody, and thanks for joining us on the Global Perspective webinar today. My name is Murray Anderson from Ashburton Investments. I'm joined by three panelists, my colleagues from the investment business, Albert Botha, our fixed income portfolio manager head, Davey from our portfolio manager and analyst from our international equities business, and Wayne McCurrie, our research and general market commentator, which probably most of you don't need introduction to. Wayne McCurrie will be starting our presentation today. But firstly, thanks, folks, for joining, as I said, and to my three colleagues for spending time with us today on hopefully what will be an interesting and interactive panel talking about the impact of COVID-19 on markets and what we can expect from equities and bonds from around the world. Hope you enjoy, but please remember to post your questions on the side in the panel, and we will take those questions when we are finished. Thanks very much. Okay, great. Wayne, over to you. I've got your slide pack up, so yeah, if you wouldn't mind, give us an introduction into the way we see the world. Over to you, Wayne.
Thanks, Murray. Thanks, Murray. And welcome, everyone. Hopefully we can show some light on what's happening here. But let's just talk about bear markets and recessions and what we're going through now. What are the characteristics and what can we expect to actually happen, and what thoughts will go through our minds and what the environment will be? Well, I think this slide sums up what our views are and where we are. You have two items on this slide. One is in gray there, the devastated world economy. The world economy has gone from estimated plus 3% growth to minus 4% growth in months, not years, in months. And yet there's the stock market having a lovely time catching the sun, nice cocktail, little music playing in the background, not a care in the world. So the economy we know is in a bad state. We know this, and we are going to see some disastrous numbers coming out over the next 2 months or so. But we are over the worst in the economy. The world's economy is recovering. The worst has happened. It just hasn't been reported on yet. And yet, here we have the world stock markets at essentially record highs, and at bare minimum recovered the majority of the losses they saw during the slowdown. And Kathy will talk about that later on as well. So our big worry is the stock market is too much too soon. We're not worried about a big bear market developing and the stock market falling 40%, but some sort of pause and correction we think is quite justified considering the state that the world is in and the state that the share markets are reflecting. But let's talk a little bit more about recessions and what to expect. Recessions happen all the time. They are very regular. There's nothing unusual about a recession or a bear market. But the feelings that people have during a recession are scary. The world will never be the same again. Life as we know it has changed forever. There's fear, there's confusion, there's panic. There's a whole lot and range of emotions that we have in a bear market and in an economic recession. And you must just remember that. These do come to an end. Some sort of normality will return to the economy, to share markets. I mean, it might take 2 years for the world to get back to where it was last year, maybe even a little bit longer. But these things do change. They do come to an end, the same as they are very predictable, by the way. I mean, recessions happen for many different reasons, but the fact that you get a recession is actually every 8 to 12 years is actually very, very predictable. Now, this one is different, same as all the other previous ones different. This one is truly different because of how quickly it's happened. And secondly, the driver, normally debt or a debt bubble bursting will drive a recession. This is obviously the virus that actually drove the lockdowns and the recession related to it. But the mere fact that we have a recession is not that unusual. And equally, we will recover and return to some normal state, either socially or as far as the economy is concerned. But we must understand and look and guess the environment going forward as well. Bad news peaks the day before an economy recovers. So we've already, in fact, passed that. The worst is behind us. As I said earlier on, The worst hasn't been reported on yet, but the worst is in fact behind us. And we must know that it's going to take time to recover, but the initial recovery is actually quite quick. So if you put the economy and say it was 100 last year, it's fallen to 80 now. The recovery from 80 to 90 is quick, but the recovery from 90 back to 100 is going to take significantly longer. So we could be in for a good 2 or 3 years of trying to get back to where we were.
Well, can I just quickly ask a question on that? So you've lived through a few of these back in the 80s, and I guess, we can go and check on what they were in the last 10, 15 years, but has the reaction from people been similar? So, I guess the markets have recovered very quickly, meaning people that had some level of confidence in terms of putting money to work. Yes, the economy is in a dire strait, but the sharp recovery. Did you see similar mindsets of investors from those times back, whether it was the internet bubble or emerging market crisis previously? Has there been very similar behavior experienced?
Yes, very much so. The initial fall is virtually identical in respect of the extent of the stock market fall and the emotions felt during the fall. What is different is how quickly the market has recovered. So normally what would happen, the share market would fall and it would bounce back and gain back 1/3 of its losses. Simply it fell too much. So to gain back 1/3 or maybe even a half of its initial loss is quite normal, and then a slow grind upwards from there. But this one, we've gained back 100 plus in an incredibly short time period. So that's the truly difference. And maybe that's a difference, the big difference between this and all the other previous recessions is just the timing. It's happened so quickly. So, as I said, the bad news will peak the day before a recovery happens. And we've had that. I mean, literally, the recovery is happening, but understand we're still going to be bombarded by a massive amount of bad news. Now, what changes? What can actually get us back on track? Why will we see an economic recovery? And it's quite simple. Free money, cheap money virtually covers all pain. We actually have had the most enormous injection either via low interest rates or via printing money, both locally. I mean, the first time that I can remember, in fact, it might even be the first time ever, that the Reserve Bank actually printed money and bought bonds. I think 30, 40 billion rands worth. But there's a lot of free money around, and it is having a positive effect, clearly on markets, but it will also have a positive effect on our economy. We've cut interest rates in South Africa, and there's possibly another rate cut to come. So even though the grind is slow, at least we are on the recovery path now. In the last few slides from my side, there's the cost of money in the USA. The US 10-year bond is, call it 0.5%. Now, 0.5%, you can borrow a lot of money if you're a government at that rate, and it hides a lot of pain. Of course, there may be an ultimate cost to all of this, but that's not in our current investment horizon. US short-term interest rates are zero. In other words, they were zero to cope with the global financial crisis. They went up, and now they're back down to zero, and they're going to stay there for a long time. I mean, interest rates in South Africa, we may even see another 0.5% cut, but they're going to stay low for quite a sustained time period. And our all-share index been a tough market for 5 years, but you can see the big fall off because of the virus, and you can see the recovery. I mean, the all-share fell to about 38,000, and it's back now at 55,000. Finally, on the rand, the rand's very predictable over the long term. That 10 years plus, rand's very predictable. It weakens by, call it 6% a year over long time periods. Right now, slightly undervalued. So fair value, 16 Rand 50, 17, somewhere in that range. The rand's at 17, so it is slightly undervalued at this level. And we predict that the rand will probably appreciate over the next 6 months to maybe a year. Just remember, the rand is a structurally weak currency, and the only time you see rand strength is after it's collapsed, which is exactly where we are now. The rand collapsed a few months ago, and now we're seeing the rand recover from that. So we're confident the world will recover. Very happy about that, making that assumption. Question is when. We think it'll take at least 2 years for the world's economy to recover back to where it was. We are defensive. We underweight shares. We're waiting for a buying opportunity. We also underweight property. Bonds have done well, and we overweight cash. So we're sitting with some money waiting to actually go in and buy some shares should we see a pullback in the market. The world will recover. It will be a better place, and we need to take opportunities if they arise to acquire assets at reasonable prices. So as a conclusion then, if this recession is as bad as the last 5 on average, in 5 years' time you will be okay from a return perspective, irrespective of the fact that we believe there could be some market pullback, but that's only a shorter-term issue. The markets will recover, same as the economy will recover, and you will benefit from that, but there's only one stipulation to you benefiting from that. That's if you're still alive. So my last slide is keep calm and wash your hands.
Thanks very much, Wayne. Appreciate you sharing your views and thoughts with us. So just before we hand over to Albert to talk about the fixed income markets, I just would like to ask a few questions related to your view there. So from an equity market perspective, yes, we've seen the all-share index rallying quite hard, but still there are opportunities in terms of various sectors of the South African market that just haven't quite recovered. So good value being offered. Any thoughts in terms of not necessarily the timing, but where one should be looking to position one's portfolio for the recovery? Certainly, you've mentioned the property sector, but banks are looking quite good from an opportunity set point of view. Maybe some thoughts there before we move to Albert, if you don't mind.
Look, timing's always an issue, and especially when you're trying to time the bottom. Shares only fall when there's bad news around, and certainly the bad news, the virus, the economic recession, is still clearly in the prices of banks, properties, and some retails. In fact, most retail shares. So the question is, there are value on a 2 to 3 year view if you assume the world will recover and if you assume the South African economy will recover. These shares show true good long-term value, but you're always scared to buy when there's bad news around. Because, as I said earlier on, shares only fall when there's bad news. You never get any bargains when there's good news around, or good news around on those particular shares. So certainly if you're prepared to maybe have a tough 6 months or a tough year and look forward hopefully to a positive 2 or 3 year return, banks show good value and so do the property shares. I mean, the property environment, very simplistically, property environment value, 20% value has been destroyed. Because capital prices are coming down, yields will fall, you'll get no money for the next year, no dividends. So 20%, let's just say 20% of value has been destroyed. The shares are down 50%. So that's the difference really.
Sure. So be selective, obviously. Watch the level of debt on the balance sheet. There's probably going to be some restructuring, but some wonderful opportunities from an asset allocation perspective. Thanks, Wayne. Albert, over to you. So maybe the point that I made there is around asset allocation. So fixed income has also had its opportunity in a portfolio, and I know from a fixed income perspective, the short end has been very much in favor because of steady interest rates that one can, or yields that one can earn out of the fixed income environment. But maybe run through us just your views on the long end of the curve as well, and just where you see opportunity. Over to you, Albert. Thank you.
Well, good afternoon. Thanks. There's a couple of interesting things that's happened in the markets. What COVID has essentially done, and there's an old political saying, is that do not waste a crisis. What COVID has essentially done in the fixed income markets is it made the South African government, we ran out of time. It shortened our time horizon to make structural and meaningful changes in the underlying economy, in the way we operate, in legislation, regulation, in the SOE frameworks, etc. Right? We are out of time. Right? That's, I think, the first lesson that we should know as South Africans. The South African government and South Africa as a country is fiscally, we've lost whatever space we had. Everything is now urgent. And when you look at the bond markets, you can see that to either a large degree or completely, that scenario is priced in. Right? So this is what I'm talking about. The yellow line is South Africa's debt to GDP as a country, right? Up until where we are now. We expect that in February next year, the budget deficit will be just over 80%. That's up from just over 60% in February this year. And then if we continue with the passive scenario, right? In other words, we just continue to muddle through. We don't make any meaningful changes, etc. That yellow line is the line that we're likely to see over the next couple of years. What that means is that from next year onwards, about 20 to 22 cents in every rand being paid in tax is being used just to service interest. And every year thereafter, that number becomes more and more. That means that pretty soon interest will be our largest element of our budget if we don't do anything. Within 2 years or 3 years from now, we will be paying more on the interest on our loans than we pay on either healthcare or education. So it is a dire situation. This, by the way, is what the finance minister referred to as the jaws of the hippo. And he wants to close the jaws of the hippo. The red line, or what's called the active scenario, is what the minister sketched out at his special adjustment budget. That's the one that was now held recently. It was now at the end of June. And that is the scenario that he wants us to do. That means we have to cut about 250 billion in expenditure over the next 2 years. It's important to note that this is over and above the 150 billion rand expenditure that they've already committed to at the beginning of this year. And the current sentiment, the current analysis by most economists and by most rating agencies is that they doubt whether South Africa has the political will or capability to enact those changes. That is why the yield curve looks the way it does. Right? So what has then been the result of that? Here we can look at effectively the gap between South Africa's yield, 10-year yield, and the US 10-year yield. Right? Now we've heard from Wayne how low the US 10-year yield is. It's been in that 0.5 to 0.8% range for the last couple of months. We know that globally rates are extremely low. Austria just did a 100-year bond, a 100-year bond, and an annualized interest rate of 0.88%. Our 10-year yield is sitting at about 9.7%. And that gap between our 10-year yield and the US 10-year yield is at about 9%. Now, if you exclude the March crisis, right, that means that the current 10-year yield level is the highest that it's been at any point in time prior to the end of 2019. If you think back to the crisis around Nenegate and how big of a crisis that was, right, the yield at that point was just over 8 percentage point difference. What was called at that stage the largest financial crisis in the history, the previous 100 years, except for the Great Depression, the global financial crisis of 2008, we saw about 7.7 to 7.5% yield differential between the US and SA. So our yields are historically high, massively high, right? So that's the first thing to remember.
So Albert, on that, if I could just interrupt you. So from the optics perspective, foreigners that are searching for investments around the world would surely look at this and say that's an attractive yield. But obviously the concern is, are you going to pay me?
Yes. So the question,
is that why we're not seeing foreign flows coming in through the door as much as we'd like to see?
The question for a lot of foreigners and for a lot of is not so much whether South Africa is going to default in the short term, right? There's no real significant discussions that is likely yet. It's being discussed more than it was 6 months ago, but it's not really seen as a very likely scenario. At the moment, the bigger question we're sitting with is, given the significant increased issuance that South Africa needs to do fund itself. At what level does debt have to clear? And what interest rates do we have to sit at for foreigners to give us significant participation? Right? And at the moment, we're still trying to find what that level is. Earlier this week, we crossed a significant or interesting period. It's one of the first times that South Africa's 10-year yield is now higher than Nigeria's 10-year yield, even though Nigeria is rated 4 notches below South Africa. So the question we have to ask ourselves is are these yield levels fair? And do they offer an opportunity? So not so much are they high or not. They are high. The question is, are they high enough for us to invest in, and do they give us significant amounts of or enough of a return given the risks that we take? So that's the one change that we've seen. The second change, and this is my last slide, is in the steepness of the yield curve. Right? So the steepness of the yield curve sounds extremely complicated. All that it means actually is how much more is the government paying, or how much more am I getting for investing in 20-year South African debt compared to 5-year South African debt. And that number is also at historical highs. But the one thing you'll notice if you look at this chart is that while our yield levels relative to the US 10-year has recovered from the spikes that we've seen in March, the steepness hasn't recovered. Right? So effectively, this is a additional premium of almost 200 points that's being priced in because of how people are saying that, you know what, South Africa's fiscal situation has become significantly more risky. Now,
okay. So to solve that problem, what we've really got to do is get economic activity back to some level of normality. But that's going to be difficult. But we've also got to create growth opportunities, employment opportunities, which is tax collection, and the fiscal starts to improve. So, that's a challenge, I guess, given this time, and trying to get through this, and then having all sorts of programs put into place by government and business to re-stimulate the economy and create growth and jobs and employment that we need.
Yeah, so we're in that unenviable position where we have to both cut spending and stimulate the economy at the same time, and that's very, very difficult to do. We don't have the advantage that the US has in issuing debt at 0.5%, right? Just the recent moves in the market over the last month is showing that the South African government that it's kind of reaching the levels at which the market doesn't have capacity to significantly absorb higher debt issuances. So we are going to have to, unfortunately, work both on the spending side and on the earnings side. Also, looking for cheaper sources of debt from international funders is going to be a must. And then increasingly, there are conversations about when does South Africa look to enter into a broader IMF program that's not just short-term, but also includes some structural reforms and help.
Okay. Albert, thank you. So there was an opportunity to buy bonds at the peak. Naturally, you and your team participated in that. We had a significant rally down, which was good for bond returns. And now we're in an environment where this sort of uncertainty, yields have kicked back up a little bit, and we're back in an uncertain world. So just in terms of positioning on the curve, just give us a sense of where you would be placed now, optimally, given the risks that sit at the long end. So where is the sweet spot, as we would call it now? So Wayne expressed opportunities in the property and banks. Where are the opportunities in fixed income?
So there are two ways you get returns in fixed income. One is just by earning the yield, and in bonds you can get a capital gain. The yield across the curve is actually quite high. But we tend to prefer not quite the short end, because the short end is very low along with the repo rate, but let's call it this 5 to 15 year space. Right? 15 years starts becoming towards the longer end where we are willing to take risk, and the 5 year starts looking relatively attractive. The 10-year bond, for example, earning 9.7% at the moment for the next 10 years. Inflation is likely to print pretty close to 2% in the next couple of months. That means that currently the SA 10-year bond is yielding pretty close to 7% real. Right now, that's effectively what SA equities has given you over long-term time horizons, is CPI plus 7. So you're getting, if not exactly the same, pretty close to equity-like returns in a low inflation environment from a fixed income asset. Now, that means that you can look at your 5-year, 10-year, 15-year bonds just from a yield perspective. If you then add the potential for further capital gain, specifically towards the front end of this curve where what's called either roll down or slide, depending who you talk to, just because of the steepness of the curve, you have the expectation for small yield rallies of anywhere from 10 to 30 points over the next 12 months, even if the curve remains exactly as it is. That adds another, say, 1 to 2%, which means that you can get anywhere between, let's say, 9 to 12% on these bonds, which is kind of our expectation for the South African bond returns from here. And if you are looking for somewhat wider, let's call it wider return expectations, I'd say that South African bonds can probably give you, let's say, anywhere from 5%, all the way out to 14% over the next 12 months, which actually makes it a very nice asset class to be in, especially given that the volatility therein still remains quite a bit lower than both your local and your offshore equity assets.
Thanks, Albert. Appreciate your insights. And Kathy, thanks very much. Over to you to give us an international and international equities overview and perspective. Thank you.
Okay, sure. So I basically work on the global equity side of the business. I think what's been really interesting in equities markets at the moment is obviously because of COVID-19, you've seen a massive revision in earnings estimates for this year and going forward. So basically, if you just sort of look to the right-hand side of this chart, for instance, the first light blue line from the right side, you can see initially analysts estimated that earnings would be there for 2020, and actually the estimates have come down quite significantly. So, I guess this isn't surprising, especially due to, the economic damage that COVID has caused with the lockdowns. But the question is, why at the moment are we, when we look at equity markets, looking at the S&P close to where it was at its peak, which was early 2020? So really the underlying economic reality of earnings is not matching up to the optimism that we've seen in the equity markets. And there's a number of reasons for this. I mean, in general, what drives markets is largely sentiment, economic data, monetary policy. And what we're seeing at the moment is a lot of positivity coming out of the markets at the moment, especially from an economics perspective. So the slide up now shows you that non-farm payrolls are increasing at the moment, which is great. So since the US has started to reopen, people are getting hiring again. So this is very positive. In terms of US retail sales, we've seen them recovering very well month on month. So people are going back to the shops, people are spending money again, people are getting employed again. And this is really driving a lot of positivity into the market. Another reason, and I think, Murray talks quite a bit, Wayne talked quite a bit about this earlier, is obviously monetary policy. I mean, whichever way you look at it, or you think about it, or you think about what it might do in the future, it's extremely positive for equity markets, and it really, really is driving a lot of investors to put more money into these sort of markets. There's not a lot of alternatives at the moment, especially with yields being as low as they are. And then second to that, we've also seen a lot of fiscal spending, or a lot of fiscal promises of spending from governments, which really will push markets and economies forward at some point. I think thirdly, what I really want to mention, which is very important, is expectations for the coronavirus. Now, we are starting to see a lot of positivity come out of potential vaccines that might be coming onto the market. Now, I think there's a lot of companies in the running at the moment, The one that we're most positive about is the AstraZeneca-backed Oxford trial. Now, this is very unusual in the vaccine world, but although the trials are still running, governments have actually started producing, or they're basically paying for these vaccines to be produced. So I think we'll probably, from the specific trial, the Oxford trial, we'll start getting a readout from the trial in about August. And it's possible, because manufacturing of the vaccine is happening as we speak, you could possibly have, vaccines ready to be deployed by late September. This is very, very positive for equity markets in general. It just really means that generally economies can do a lot better if we obviously put an end to what's happening at the moment. Look, obviously these vaccines have to get globally, but I know the US and the UK have invested enough for about 2 billion vaccines to be available by the start of 2020. It's not 100% that these vaccines are going to work, but it's just very, very interesting and positive, very positive.
Kathy, just on that, you're talking now healthcare. So I want to go to the portfolio that you manage in the global equity side. So from a fund management perspective, it's very much looking for quality companies. And I know in your portfolios are healthcare stocks that you have. So obviously this, what one would be looking for is defensives and things that are benefiting from this crisis, and companies have been able to see through it. So maybe if you can just talk about some of the healthcare stocks you've spoken about, the retailers, consumers coming back, and there's certain areas of the retail market that would be supported. Maybe just give us a sense of what's in the portfolio, what you've looked at, what's exciting, and what's done well.
Okay, so generally we stick to quality companies with strong balance sheets, so which over periods like this can basically survive. They might, you might see some earnings going backwards, but they generally are defensive. So we are overweight consumer staples at the moment. Those stocks have done well for us. We've been overweight healthcare. That's done well for us too. However, in markets that start trending up that we've seen over the past 3 months, you also do want to have some exposures to companies that I guess have, a bit more, that have higher betas, that do better in uptrending markets. So these are areas like financials, industrials, the energy sector. However, you also have to be very careful. So, financial sector, we are about equal weight at the moment. We are very underweight banks. We still think there's a lot of risk there. We still think a lot of companies are going to come out with poor results or possibly insolvency. So I think we want to stay a bit wary there until we're ready to kind of go a bit overweight there. Generally, we're just looking for ideas where companies, as you say, will benefit from what is happening at the moment. So I think very obviously is the tech sector, companies like Microsoft, which is benefiting from stay at home because of Teams, data centers, the cloud. One
of my favorites is Home Depot. Everybody's doing some home maintenance while you can get your stuff delivered to your door. So, great idea. Yeah. Paint the house, renovate a bit. So Home Depot is one you've got.
Yeah. So Home Depot is actually quite an interesting one because it's a company we really love. We did a lot of maintenance research on the company pre-COVID. It's a discretionary retail stock. So at times like this, it doesn't actually tend to do very well because people stop spending. You probably spend less on your house. However, what's happened is because you've had this economy where people have stayed more at home and perhaps they've had more time to fix things themselves, but also maybe notice that things are broken. Home Depot has done very well over this period. So let's say much better than the market expected. So the share price is back to where it was at the start of the COVID crisis. But they also invested a lot in terms of online, their online capability. So a lot of people, when they had to shut their stores, a lot of people could order stuff online. They're looking to eventually aim to have delivery within a day anywhere, in 90% of the US. So it's just a fantastic model. They've really, really adapted to where the world is going. just in terms of, the consumer sector, again, another great stock that we have is Reckitt Kaiser. The reason we entered, so this is a consumer health and hygiene company. What we really liked about this sector is even pre-COVID, this really is a nice trend in terms of consumers are becoming a lot more health conscious. They're taking a lot more vitamins. They're becoming more conscious of hygiene. So it's a very high growth sector, but Reckitt Kaiser, went through a few years of, let's just say poor performance, largely for things that they did, to themselves, but also because of things that were beyond their control. But they came in with new management. We got a little bit more excited, and of course we invested in the right time. We bought them in January, and they have literally been, their sales growth in the first quarter of the year was about 13%. And this is because they sell products like Lysol, Dettol, home cleaning products. The more people are staying at home, the more they're spending money on these types of products. So that's great for now. What about the future? I think structurally that market has changed. People generally are going to continue to spend money, more money than before, on things like hand sanitizers, on cleaning their houses. And so it was a great structural trend before, but I think it's even become a better structural trend. Yeah. And those are the companies we like to look for.
I want to bring, thanks Kathy, I want to bring Wayne in here before I let you carry on a bit because there's some other interesting stuff in the portfolio. But Wayne, in the South African context, we've seen similar companies benefiting from the same thing. So the consumer in South Africa going online even more so than previously. Any thoughts on companies, that maybe have or haven't done, bought their stuff online are going to suffer in the future, or give us some ideas there. And has there been sort of in the building trade? I know there are a couple of providers in that space. Have they benefited?
Look, the building side has been very tough for a long time. We've seen quite a few people obviously leave the construction sector, but the builder's warehouse type of operations actually doing reasonably well. So certainly cash build can be an opportunity to actually go in and have a look at it. But I think it's too early. South Africa is still a long way behind the rest of the world when it comes to online retail and that. And even though it has gone up, it is still probably less than half of a percentage of turnover as what global companies are, on a like-for-like basis. So even though it is a factor and it clearly has been boosted, it's still relatively small in our environment in South Africa.
Sure. Well, and just one of the local issues, obviously lots of companies coming to market, issuing shares or raising capital in some form. That's apparent because obviously they've got to prop up their balance sheets where consumption or revenues have fallen. Are you overly concerned about that? Or again, is it just you've got to pick the eyes out of a quality company that's going to sustain itself through this crisis?
Look, there's been two big, broad share issues. People who are opportunistic, who want to buy something, which is good for the company because you can buy things cheaply when news is bad. But the overwhelming majority has been, we need more money, otherwise we are in deep trouble. Balance sheet debt, gearing ratios, bank covenants, etc. It must be very painful for a company to issue shares at these prices because that's the most expensive capital you can raise. Sure. So generally speaking, if we own the company, we like the company, and if it's going through tough times now, it'll probably get better, and the shares are issued at a discount. So for shares that we own, we will take up the rights issue, but be very cautious about taking up any other rights issue, specifically if there's big debt in the company.
Yeah. So Kathy, back to you. So the point here around international portfolios, you can obviously go to different geographies. Now, an interesting one is into China. So you've got exposure into China, Ping An Insurance Company. So again, good growth opportunity in a different market, probably not something many people wouldn't have known about, but great upside down opportunities because of the population growth and people coming out more and more into a higher income earning brackets. Maybe just a thought on that one.
Yeah, so I think, in terms of the way we look at our global portfolio is that we do have a lot of exposure to developed markets, but at any point we feel positivity in terms of the emerging markets, we can tilt the portfolio towards that direction. And that's how we have felt recently. I think China clearly is coming out of the crisis a lot quicker and a lot faster than I think a lot of people expected. And certainly, it seems a lot faster than some other developed markets. Possibly there'll be growing GDP growth this year. So, to have a bit of exposure to that, especially because of some of the share prices are still quite beaten down. One of the most attractive companies we found in that space was Ping An Insurance. Now, so just to give you an idea, the company is one of the biggest life insurers in the world. Basically, it is situated in China. That's a market it concentrates on. But yes, as you say, you have this great demographic in China. You have a huge amount of the country merging into the middle class. I think I saw some stats recently where about 55% of the country will be middle class within the next few years. And these are the people that are going to be buying products such as life insurance. So, and not only that, they're also highly innovative. They invest a lot in technology. They have about 1.3 million agents. It's just a very well-run company with huge growth potential because of the market it operates in. So, yeah, we're very excited about that company and that space and great exposure to that region of the world.
Sure, thanks. So maybe just a last thought from my side and comment from yourselves before we end off, and just a reminder, hopefully people have been posting questions on the question functionality on the webinar. Wayne, Albert, when does inflation come back into the system? We're probably in a deflationary environment for some time, but obviously everybody's trying to stimulate this market. What does it mean for us going forward?
Look, I would doubt if there's consumer price inflation overseas for a number of years, and even locally. I think we're going to have low interest rates and low inflation simply because there's no demand. I mean, understand locally we have other dynamics, which is the government and Eskom and municipal rates and taxes and let's call it administered prices that aren't influenced by demand and supply. Food inflation is coming back, but I agree with Albert. Inflation will be very low for the next month or two, but next year it will go up, but it'll probably only go up to halfway in the Reserve Bank's range. I don't know if you got any other comments to make there, Albert?
Sorry, I was on mute there for a second. Sorry, I agree with what Wayne said. Inflation is unlikely to be a concern in the short term, unless something goes significantly wrong. So it's not to have low and long-term low inflation. And when I mean low, I mean below 4.5%. For the next foreseeable couple of years is our base case. Having said that, the degree to which we are entering a debt problem has historically, if it spirals out of control, quite often led to inflation being one of the side effects over a longer period of time. So in the short to even medium term, inflation does not seem to be a concern, but over longer time periods, it's a edge risk that one should take into account. And then when you invest in assets, in fixed income, real assets are looking attractive. And then offshore assets are always a good hedge against inflation, and equities tends to be a good hedge against inflation. So South African investors, at least from that perspective, are in a fortunate position where they've got significantly higher number of potential sources of real returns than many other investors do if they structure their portfolios correctly.
Sure. You mentioned an interesting point there, just the last comment then, and again we'll take some questions, is so real assets, I mean including commodities, and eventually, you find that when the world starts to retool and the infrastructure spending happens and these commodity prices start to surge, and we've seen a bit of that of late, certainly the gold price, maybe that's more sort of defensive hedge, but Wayne, a thought on that, on the commodity play?
Mary, look, commodities have had, surprising enough, a very good time during this lockdown. I mean, gold has done extremely well. but even the industrial commodities have actually held up surprisingly enough. They're actually resilient given what's happened to the economy. So you would have thought there was a lot more pain would have been reflected in the iron ore price and in other commodities. Look, agricultural commodities haven't done well, but industrial commodities, which is really where the focus of our share market is, have been surprisingly resilient in this environment. The shares aren't cheap. I mean, gold, you can argue, can go up some more, but that's more of a hedge against uncertainty than an investment call on the profitability of gold and gold mines over the longer term. But now is probably the time that if you're lucky enough to have a big mining exposure, you've got payoff, sell that down a little bit and, look into the other opportunities that might be there in the market. I agree, shorter term, you must be very cautious. But if you take a 2 or 3 year view, over the next 6 months or the next year, you want to be buying banks and financials because they actually show relatively good value.
Yeah, great. Okay, folks, I think we've come to the end of our time. I just wanted to say thanks again, Kathy, Wayne, Albert, for joining me, and we'll take some questions now. Much appreciated. Okay. Great. Thanks very much, everybody. There's been great questions that have come through. Quite a lot of them, and I don't think we'll get through all of them given the time we've got left. But to start off with, Albert, maybe to you from a bond market perspective, there's two that are kind of linked. So in June, we had a 1.2% drop in the bond market. And there was a question about why that was such. And then just around the rating agencies and, further downgrades and what the impact that will be on bond markets.
Okay, thanks, Murray. So there are two primary factors for the market moves we saw in June. Some of it was local and some of it was offshore. It's always difficult to disentangle how much is from each. We saw that from the bottom of the market, which was around about the 6th of June, credit spreads in ITRAX Europe crossover debt, as well as some high yield debt, as well as other emerging market spreads, actually increased towards the end of the month. And some of that filters through towards South Africa. And then in South Africa specifically, increasing awareness that the special adjustment budget was not going to be very favorable for us, and that there would be some bad news coming out of it. It was some of the numbers were leaked beforehand, so there was a little bit of a realization that we are in a lot more fiscal trouble than I think people thought, and those probably are the two primary factors that have affected the recent moves up in the bond market, not just in June, but also actually the first couple of weeks in July. When it comes to the rating agencies, they don't tend to be proactive. They tend to be reactive. So they'll at least, some of the next moves will come, probably after the NTVPS. If our debt to GDP ratio follows the passive route, we'll continue to get downgraded as things move forward. And that will continue to affect our yields. We should, however, remember that the market tends to move in anticipation of the debt downgrades. We saw in South Africa in March and April, as well as with some previous downgrades, that the market actually adjusted upwards. Its yields adjusted upwards before the rating downgrades occur, not thereafter. So it's not so much that the rating downgrades will affect the yields. It's that the rating downgrades will reflect the situation in South Africa, which hopefully by the time the downgrade occurs, the market will have mostly taken into account.
Okay, thanks, Albert. So the questions have come thick and fast, and excuse me, I turn to my left all the time just to read them. I'm not going to go through every single one, but I think there's been some good ones which relate to the equity markets, Kathy and Wayne, and particularly the question around, just summarizing, growth versus value. So growth has obviously been the story of the day, but clearly both in the domestic front and the international front, there's some great value opportunities that are appearing. Maybe some thoughts on that first, Wayne, from a domestic perspective, sectors that may be offering value, and do you think value reappears? And then Kathy, maybe you can give a thought on that from an international equity perspective.
Thanks, Murray. Look, clearly it's been a one-way street domestically and locally for a long time now has just been growth shares. And we all know the shares that have done it in South Africa. It's Prosus and Naspers and a couple of other shares, but those have dominated our market for years now, if not a decade. And there are value shares out there. Now, when you look at value, I mean, it's very difficult to determine exactly what value means, but these are companies that are trading at a discount to either their normalized valuation or what they could achieve or what their book values are, etc. So to me, the value sectors in South Africa clearly are, number one, banks. Banks are trading at the biggest discount to their book value that we have ever seen, quite frankly. I had a look earlier on today at some banks' price to book, and it is literally at historical lows. We have never seen them trading at such low prices relative to their book. We all know what's going to happen to earnings. Capitec said earnings for the 6 months to June is going to be down 70%. And I think it might not be that bad in the other banks, but there's going to be a big number. But looking through that, banks clearly show value. Some retailers, also trading at very, very low valuation levels. And then I suppose the real big one is the property sector. Now, I know absolutely. It was up 13% odd last month. But when you look at the price to book or the price to tangible asset value on properties, I mean, they are at massive discounts. Now, you assume over time that property values are relatively stable. They will fall this year, call it 10 to 15%, and that's unprecedented, by the way. Normally, a bad year is maybe 2 or 3% down. But yet the shares are still 50% off their previous highs. It is risky because obviously property sector is taking massive strain in this environment, but there seems more than enough bad news in the share prices. So property as well showing value.
And I guess within that, Wayne, there's, the different property style REITs that you would look at, whether they, commercial, industrials, the storage type play, etc. So you'd really need to go and look and pick the eyes out if you were looking to have an allocation given a recovery and an opportunity set. You've actually got to go. It's not just a blind allocation to property, I guess.
No, but look, a lot of the big ones, Growth Point, Redefine, etc., are well diversified portfolios.
Okay, thanks, Wayne.
Kathy, global value?
Yeah, so growth has outperformed value for so long now. It feels like it will continue forever. But of course, there was a time that value did outperform growth. And it does go through cycles. This has just been an exceptionally long cycle. And I think the reason why, the theory is, I guess, is that interest rates are as low as they are, which means growth becomes more valuable. I think that possibly things like what we're going through now can change that trend. So us for global leaders, we have both growth and value, and we think it's important to be investing in both of those strategies. I think that there's a lot of growth stocks, especially within the tech space, that have been moving higher and higher. And for us, it's getting a little bit scary, so it's almost feels a little bit like the dot-com bust. And I think, yes, a lot of these companies are generating earnings that justify their PEs, but I think a lot of them don't do either. So I think it's better to have a mix of both. I think there's some great value companies out there at the moment, and you don't want to fall short and not be in that style to a certain extent.
Okay. So again, let's go back to the point: quality, good balance sheets, good proposition, good brands. And to that, there was a question about the Louis Vuittons, the Gucci's, the Burberry's. I know that you've looked at. Maybe just a thought, because I always, interesting consumption patterns around the world. The rich will continue to spend online. Maybe just a couple of thoughts there.
So I think just in terms of the luxury goods sector at the moment, what's interesting is they have been hit quite badly recently, just in terms of sales growth, and the reason why is because they depend a lot on travel. So I guess in a normal instance, it's a discretionary consumer sector. However, they tend to be more defensive than some of your other high street retailers. I think it's a great sector. It's very, very well supported, especially within Asia Pacific. It's very well supported between the generation X and Y. So a lot of the younger generations, especially again in mainland China, are coming into that sector. I think it's going to grow well, but I think in the meantime you are going to see these companies in terms of sales growth hurt a little bit. But long term, I think it's a good play.
Okay. Thank you. I'm really conscious of time, and so just maybe I'm putting a couple of questions together here to get your last thoughts. So the question has been, South Africa coming into COVID was under pressure. The economy was not looking good. Clearly, we're in a situation where it's really looking dire. So the questions are related around that have been, how do we get out of this quickly? And linked to that is, can you find good enough value to commit to investing in South Africa, or from an asset allocation perspective, should you just be taking your money offshore and investing into developed markets around the world? So, Albert, maybe, and if I can throw you a difficult economics question and maybe a when does COVID end question. So I know you like, from an analytics perspective, to look at these graphs and data. Maybe that's thrown in. There's a question on peak infection rates and recoveries for South Africa, economic stimulus, and maybe then an asset allocation. Each of you can share a thought. Are the opportunities dripping enough in South Africa, or should you go offshore? Albert, good luck with that one.
So there's also a question on here about what South Africa will need to do to get the growth running. And I'll try and roll as much of that into one question as quickly as possible. So I think one of the first things is we need to show a willingness to make some of the hard choices, right? Easy one is SAA doesn't need to exist, right? And so you can make several things that everyone knows should happen for the country to start getting on the right track. SAA shouldn't exist. There need to be a couple of high-profile arrests for people that we know are corrupt. You need to make structural changes to the economy. The reason the bond market has spiked and the reason the equity market in SA has lagged some in developed markets is because at this point in time, the South African government has lost the credibility in turnaround plans, right? The market no longer believes that, we'll be able to hit the targets. We've missed one target or another in restructuring, in corruption watch, in debt consolidation for most of the last 7 or 8 years. So we need to be shown that we can make the hard choices. When it comes to COVID and stimulus and those kind of things, we can't stimulate as much because we don't have the fiscal room. We have to get our economy back on the road through structural reforms, right? Someone said the other day that getting South Africa back on the road is not complicated. It's very difficult because the choices are hard, but it's not complicated. Most people know what choices need to be made. From an asset allocation perspective, I think, and here my colleagues will probably disagree with me, or not, maybe not, is that everyone has to some degree some fixed income exposure in their retirement portfolios. You have to. It's regulation requires it. But almost all of that fixed income exposure you can keep in South Africa because you can get real returns for your fixed income exposure in South Africa. That means you'll bias your fixed income exposure to South Africa and you'll bias your equity exposure offshore. And I think if you've done that historically, if you do that going forward, it's probably going to give you good output. And then if you can go with Wayne's suggestion and you can carefully select some other companies, I think you'll still have a decent output.
Thanks, Albert. Wayne, some thoughts?
Sure. Look, over time, you want a very, very large percentage, a majority of your exposure in a balanced fund or an equity fund to non-rand assets. There are opportunities in South Africa, but over time, the world is probably a higher growth opportunity with more diversification possibilities than South Africa. And it doesn't mean you don't buy the JSE because the JSE itself is 70% global exposure. But understand over time we have a structurally weak currency. we have still got many, many difficult things, as Albert was saying, to do before we can even think about going back onto a high growth path. And these tough choices are going to have to be made quite soon. But there are opportunities in South Africa, as I spoke about banks, with some risk property. Bonds, I definitively agree with Albert, is that bonds show a very, very good yield return profile, risk return profile going forward. But over time, you want your money overseas, but you mustn't ignore any possibilities, any sort of like good value plays here in South Africa.
Thanks, Wayne. Kathy, last word from you.
Yeah, it's interesting. I actually saw a study once that said, but it was probably from an American, that basically said you should have your proportion of onshore assets in proportion to the GDP of your country globally, which means we should have 1% of our assets in South Africa, at about 1% of our portfolios, which obviously is not really possible. And as I said, was probably an American where they're a much bigger part of the GDP, but of the globe. But yes, I mean, I think it's very important to have offshore assets. And just from a diversification point of view, a couple of years back, you probably would have got quite a similar return from the, let's say, the JSE and an offshore index, when you take into account the growth that the JSE did experience over a certain period. But, at the moment, over the past 5 years or so, you would have suffered quite a bit just being in South Africa. And so that diversification is very, very important and very key in what we do.
Folks, thanks very much. I appreciate Kathy, Albert, and Wayne for your time and sharing us your thoughts on the webinar today. Thanks to everybody that dialed in. Thanks for the questions. Appreciate you spending the time with us. Unfortunately, at the top of the hour, we've run out of time, so we really do need to say goodbye. Please check in with us, email or on our websites. Love to hear from you and engage and talk about our views further. Thanks very much and have a good afternoon.
Thanks.